$3 trillion. Gone. That's not a typo. $3,000 billion. Vanished from the stock market in a single day. And somewhere, right now, a news anchor is saying the words that have terrified people for 100 years. Billions have been wiped off the market. So where did it go? Did some secret group of billionaires steal it? Did it get sucked into a black hole? Is it sitting in a government warehouse somewhere next to the lost Ark? I'm going to tell you something in the next 10 minutes that your school never taught you. Something that changes the way you look at money, markets, and wealth forever. And I'm going to prove it to you using nothing but a used car. Stay with me here, because this analogy is going to make everything click. You walk into a used car lot. You find a perfect car. The salesman tells you it's worth $20,000. You check online. Yep, every similar car is selling for $20,000. So you buy it. 20 grand. Done. You wake up the next morning feeling good. You own an asset worth $20,000. But here's the question nobody asks. Who agreed to that number? You paid $20,000. But that doesn't mean the car is worth $20,000. It means that on that specific day, you and that salesman agreed on $20,000. The car's value was never a fact. It was always just an agreement. Now here's where it gets interesting. 3 days after you buy your car, an economic crisis hits. Fuel prices explode. Unemployment rises. People stop spending. Suddenly, nobody wants to buy used cars. And every dealership in the country drops their prices to move inventory. The same car you bought for $20,000, it's now selling everywhere for $14,000. You just lost $6,000. Except, look at your car. Really look at it. Same doors, same engine, same seats, same everything. Nothing physically changed. Nobody broke into your driveway. No one took anything from you. So where did that $6,000 go? It didn't go anywhere, because it was never really there. That $6,000 existed only as long as someone else was willing to pay $20,000 for your car. The moment people stopped believing the car was worth $20,000, that value ceased to exist. It wasn't stolen. It wasn't transferred. It simply stopped being believed in. And this, exactly this, is what happens every single time the stock market crashes. When you buy a share of a company, you're not buying a product off a shelf. You're not buying a building or a machine or anything physical. You are buying a belief that this company will grow, will make more money next year than it made this year, will be worth more in the future than it is today. The stock market is one massive, never-ending auction, running every second of every trading day. Millions of buyers saying, "I'll pay this much." Millions of sellers saying, "I want this much." When they meet in the middle, that becomes the price. Computers match them instantly. Done. But notice something crucial. The price only means something at the exact moment someone pays it. Your share is worth $150 today because someone just paid $150 for one like it. That's it. That's the entire foundation. Not a vault, not a guarantee, just the last price two people agreed on. Now, the company reports bad earnings, or inflation spikes, or a war breaks out, or, as we've seen recently, a chaotic tariff policy sends shockwaves through the global economy. Fear enters the room. Buyers pull back. They don't want to pay $150 anymore. Maybe $110, maybe $90. Sellers, seeing prices fall, panic. They want out before it drops further. And just like that, the price collapses. Your share that was worth $150 yesterday is worth $95 today. You lost $55 per share. But again, look around. The company still exists. Their offices are still open. Their employees still showed up to work this morning. Their products are still on shelves. Nothing in the real world changed overnight. Only one thing changed: what people believe that company is worth. That lost value wasn't money sitting in a pot that got spilled. It was confidence, and confidence evaporated. So, does real money ever actually get destroyed in a crash? Yes, absolutely yes. But only in one specific way: when people panic and sell. Back to your car. Let's say you see your $20,000 car is now worth $14,000, and you completely lose your mind. You call a dealer that same day. You sell it. 14,000. Done. That loss is now real, permanent, locked in forever. But your neighbor, same car, same situation, decides to wait, does nothing, parks it, goes on with his life. 2 years later, the economy recovers. Used car prices bounce back to 20,000. Your neighbor lost nothing. You lost $6,000. Same crash, same car, completely different outcome, based entirely on one decision: whether to panic or stay calm. This is the single most important lesson in the entire history of investing. The Great Depression of 1929 is the most catastrophic example of what happens when an entire society panics at the same time. Banks panicked. Businesses panicked. Ordinary people lined up outside banks to pull every dollar out before it was too late. Everyone tried to sell everything at once. And when everyone sells at the same time, there are no buyers left to match them. Prices don't just fall, they free fall. Businesses collapsed. Banks failed. Unemployment hit 25%. Real wealth, real, tangible, life-changing wealth was destroyed. Not because the market fell, but because mass panic turned paper losses into permanent ones. Fear didn't follow the crash, fear was the crash. Now here's the part that the headlines always bury at the bottom. When the market crashes, someone is on the other side of every single trade. When you panic sell your shares at a low price, a calm, patient buyer is purchasing those exact shares at that exact low price. The money doesn't vanish, it transfers from the emotional to the disciplined. This is why the greatest investors in history don't fear crashes, they prepare for them. They wait for them. They have cash ready specifically for when everyone else is running for the exit. Because a crash isn't a disaster to them, it's a clearance sale. Pull up any 100-year stock market chart and you'll see the same pattern every single time. Crash, recovery, new high. Crash, recovery, new high. Crash, recovery, new high. The 2008 financial crisis wiped out nearly half the market's value. Within 5 years, fully recovered, then doubled. The 2020 pandemic crash was the single fastest market collapse in recorded history. 30% gone in 30 days, recovered within 6 months, then hit all-time highs. Every single time. The market isn't a casino where the house always wins. It's a scoreboard for human productivity. As long as humans keep building companies, making products, solving problems, and generating value, the scoreboard keeps going up over the long run. Crashes are the storms, not the end of the season. So let's answer the question properly. When the stock market crashes, where does the money go? Most of it goes nowhere, because most of it was never real money to begin with. It was belief, confidence, collective expectation about the future. When confidence breaks, values drop. When confidence returns, values recover. Real money is only lost when panic turns a temporary drop into a permanent one, when fear forces a sale that didn't need to happen. The market isn't a vault that gets robbed during a crash. It's a mirror, reflecting how optimistic or terrified millions of people feel about tomorrow. And the secret that changes everything? You don't have to feel what everyone else feels. You just have to stay in the car. If this made the market make more sense, the next video breaks down exactly what triggers a crash in the first place, the warning signs, the patterns, and what history says happens next. See you there.